Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. Joining me today, my guest is Louis Camrosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. We bring you guys a real estate podcast every week. It's the down and dirty on what's actually going on in the real estate markets. We're here to tell you what's going on in the markets, how it can affect you in your real estate decisions, whether it's interest rates, whether you're looking to buy or sell a home, and the troubles or problems that you can potentially run into because of what's going on in the markets. Louis is often cited in the media as a real estate industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How you doing?
I'm doing well, sir. I was on vacation last week, as you know, so I'm trying to, obviously, this week get back into the swing of things. Last week we had some interesting stuff, so I think we'll go back and touch just on that for a second, where Fed Chairman Ben Bernanke testified before the House and Senate last week as a part of his semi-annual monetary policy report. And as you and I have been discussed for some time, the traders had been very focused on the timing of when the Federal Reserve would begin to reduce the amount of monthly Treasury and mortgage-backed security bond purchases. So actually last week, rates started to get a lot better, really because Bernanke had most recent comments pointed that the Fed were going to actually wait a longer period of time before they started tapering their monthly purchases. Obviously, before that, the speculation was that they were going to start tapering in September, which you and I kind of said all along, that how in the world are they just going to start cutting it off in September when there's nothing that's actually moving in the right direction as far as the economic indicators that you and I would look at to actually say that this economy is improving. So they basically are backstepping now. And the markets, reacted, interest rates did get better. But then moving into this week now, they kind of gave up a lot of the gains that we got last week. So it just seems like it's just teeter-totter, back and forth, and, it's not going to really, I think, swing, to go back in the 3.5% interest rate range where we were, because there's just going to have to be so much negative news, which I'm convinced at this point that the Fed monitors the economic reports that come out and the language that they put out to try to make it so that things stay somewhat stable. When I say somewhat stable, I feel like they're going to try to keep interest rates so they don't really move higher than 4.5% or somewhere in that range. Louis, what's your take on that? Obviously, we had initial jobless claims come out this morning. U.S. jobless claims climbed 7,000 from the last report up to 343,000. They were expecting 342, so there was actually another 1,000 more than they expected. Obviously, we've been saying all along we don't really feel like the employment situation is turning around, and with these numbers, obviously, it's showing that it's not. What's your take on this, and what do you think the Fed's going to come out and say about it as well?
Okay, well, let's just recap what's happened, as you did in the last couple of weeks. The Fed started out by talking tapering, and that spooked the markets. The interest rates rose. And then, as you and I have been talking about, when they had that number, the unemployment rate needed to go below a certain percentage, and you and I had been talking for weeks that the unemployment rate really doesn't accurately reflect the state of the employment market because it includes part-time workers, it doesn't include people who stopped looking for work. And we heard 2 weeks ago when Bernanke started his kind of Dove campaign, he mentioned that the unemployment rate at 7.6 overstates the health of the employment market. Now, 7.6 isn't even a good number, and he said that it overstates the health of the employment market. And then he even noted that there's high rates of underemployment, and he mentioned the very low labor participation rate. Now, if that wasn't enough to say that the economy is not really doing that well, he then, in the Q&A period last week when testifying to Congress, said something quite remarkable that was not picked up. He said, I don't think the Fed can get interest rates up very much, this is an exact quote, because the economy is weak. Inflation rates are low. If we were to tighten policy, the economy would tank. Okay, so he's saying what we've been saying all along, but with the media's been ignoring and keeps continuing to look at every last piece of data as somehow evidence of a recovery. And you and I know that the employment data isn't good. The GDP number isn't going to be good this quarter. Caterpillar just came out, missed the revenues by 15%. That's a bellwether for the state of the global economy. So we're seeing that the Fed is admitting the economy is weak and is admitting that they need to keep rates low. Now, let's talk about the taper. They have kept interest rates low not just because they keep the interbank rate low, but because they're in the market buying $85 billion worth of US Treasuries and mortgage-backed securities. If they were to stop buying those, i.e. start to taper, it doesn't matter if they say, well, we're not going to raise rates. Rates will rise anyway because when you take the Fed out as a purchaser, the demand for those securities goes down, and obviously then the yield goes higher. And I think, and you and I talked about this is what I want to get your thoughts on, Ryan. If you recall back before the 2012 election, there was a lot of talk about whether the Fed was going to increase QE, whether they were going to do something more. And we both kind of said, nah, they'll do it, but they'll wait till after the election because they're going to want to have some credibility so it doesn't look like they're grandstanding. Well, we were wrong. 2 weeks or a week before the election, they just went ahead and boom, they just decided they're going to up the QE 3 plus or QE infinity, whatever you want to call it. Now, what I've been thinking is the Fed has been making all these noises about tapering. And you and I have said they can't because Bernanke just admitted that if they were to raise interest rates, the economy would tank. And I'm thinking, well, they've kind of put themselves in a corner. They've been talking taper. They can probably go from 85 million down to 65 million. And 65 million is still a huge amount. It's bigger than QE1 and QE2 if you take it on a monthly basis and annualize it. It's still $780 billion a year as opposed to $1 trillion. And I'm thinking, well, come September, that's the expectation. They'll probably have to bite the bullet and do 65 billion. But now I'm thinking, I don't think they care about any type of credibility. They can always come up with something, continued weakness in the labor market. He's already signaled now he's focused on that. He can focus on the Q2 numbers, which will be out, the GDP numbers, and then all bets are off. So if he tapers, my view, Ryan, is that he'll do it in September. He'll go to 65 billion, keep it there for a couple of months, and then just ratchet it back up. Or if they really don't care about any type of credibility and they just need to keep the presses going, printing presses going, they just won't taper at all. And they can cite a million reasons why we still need QE. The housing market is one of them. It's gone. Mortgage applications are down. Housing is considered the key to the recovery. If housing slows, then what have they got? If the economy drops, those are the two linchpins of this so-called recovery, and you undo all the supposed good of having put $2 trillion worth of QE into the system if both of those stall. What are your thoughts on what they might do in September?
I think they're not going to do anything at all. I think that, like you said, they've kind of backed themselves into a corner, and now that they're basically backing off of the taper language almost altogether, I think that the Fed actually probably is maybe actually looking at the same numbers that we're looking at finally, instead of saying, the close to 7.5% unemployment rate that doesn't mean anything to you or I, is not actually what's going on, and they're finally realizing that we got to be careful here. They made those comments about tapering. I don't think that they realized of how big of an impact that was going to have on the overall interest rate market. And
just talking taper.
Yeah, just talking taper. How big of an impact that had. I mean, interest rates were shooting up out of sight. So now it's like, okay, whoa, we can't talk taper, period. Because the minute that we do, the markets are going to respond, and people are going to start to pull out. I mean, there's probably only about 30% of private investment in mortgage-backed securities now, but that would shoot down even lower, and then you have less funding coming from basically the lender of only resort of buying mortgage-backed securities. The Fed saying they're going to back off their purchases. Rates will absolutely skyrocket to, I think, levels that people don't think that they'll get to. So I think that at this point in time, moving forward, they're not going to do anything. To me, Lewis, I think they're going to have to come out with language eventually that says, hey, you know what? We're not going to be doing any tapering for at least another year or two, because.
Well, what about increasing?
They could potentially increase, because I think that if the numbers keep, trending upward, especially as far as initial jobless claims and all the other employment data that they're gathering, they're not going to have the choice to do something but to stimulate more, because otherwise we're going to continue to have all this negative economic news with basically the Fed with their hands tied, and the only thing that they can do is to continue to stimulate or keep things the same. And I think that they can only keep things the same for so long before people are like, oh, well, this isn't actually moving. I mean, the only reason, mortgage applications were moving before, Lewis, was because everybody was trying to take advantage and refinance.
Right.
Well, now that you can't refinance because rates have gone up, there's not near as many people out there, eligible people, that are actually purchasing homes as we're finding, right? That number, I think when you just read into the mortgage application number, but you don't actually pay attention that, 70, 80% of all those applications are refinances, it doesn't really give you a clear indicator of what's going on in the real estate market. And then
the amount of new homes sold and the amount of homes sold, period, are far below the 2005, 2006 level. Forget that prices are closing in on the same levels, in some areas are higher. The number of new homes sold in June was 497,000. At the peak in 2005, we were selling 1.5 million homes.
Yeah, it's not.
That's a dramatic difference in the amount of economic activity that's created by building new homes.
I agree. And, not only that, you just mentioned that Caterpillar was down. I mean, typically when the real estate industry is moving, I mean, they're doing quite well. I think overall, and you know what, a lot of this has to do with access of capital. Like I said, many businesses are struggling now because they don't have access for capital to actually expand their business, to grow. They're having to cut their employees back to part-time workers instead of full-time workers because of the looming Obamacare that got pushed back a year, but that's not going to stop them from planning now. They already know that, they already know the course of that this is going to take place at some point in time, so we just need to go ahead and plan now. Well, by planning now, our employment situation is getting worse, not better. We're going to have more people taking more part-time jobs, not getting full-time work. That's not good for the overall economy. It's not good for businesses themselves, hiring double the amount of employees, having to train double the amount of employees. I mean, there's not much stability with that model to me. I mean, I don't know how you feel, Lewis, about it, but I'd much rather have, the same group of guys and gals working together than, people doing shift work, just to skirt around the healthcare reform.
Well, there's two things at play. I mean, if the economy really was booming, and you look, in the 60s, we had the Great Society and we had the Vietnam War, but the economy could withstand that. The amount of spending that was being done, all the programs, because the economy was doing well. But you can't introduce these types of plans and impose them on employers when the economy isn't doing well. I mean, I heard the president speak yesterday. He was making it sound like somehow the companies were doing the country a disservice by not hiring people. Well, they're not hiring people because their businesses can't support it.
Right.
They're not in business to hire people. I think that's a misnomer. Companies don't start up to hire people. That's not their role. Their job is to make money for their shareholders, not to hire people. They hire people if they're making money for their shareholders. Then they need the employees. So I don't see how we can improve the economy when there's all these additional costs being imposed on it, and then blaming the companies for trying to navigate through a difficult economy when nothing's really improving. Is really directing it it's really putting the blame in the wrong direction.
Well, absolutely.
Because,
he wouldn't put the blame on himself, Lewis. I mean, throughout the whole time that he was campaigning, saying that these things are going to turn around, jobs are going to turn around, and now they're not. It's easy to point the blame at the rich and just say, hey, you guys aren't hiring people. It's your fault. You're the reason why the economy is not turning around because you won't hire anybody. Well, obviously they're not going to hire new people if they know that it's going to double or triple their cost. If anything,
at the same time, Ryan, then he talks about the 401k plans improving. Well, they're improving in a way, and he was claiming yesterday that helps middle-class people because their 401ks rise. The reason their 401ks are rising is because companies are cutting back on their expenses i.e. not hiring people or actually letting go employees, which is increasing their revenue or their earnings per share, which is making the stock price go higher. So you can't have it both ways. I mean, because if they were just to go out and be socially responsible and hire a bunch of people that they didn't need, but because the president thinks we need to hire people, their share prices would plummet. And then the same people that were supposed to be helped, they may have a job, and now their 401k plan is down 30%.
Yeah, I mean, you're exactly right. I'm looking at the Dow right now. It's at 15,442. NASDAQ is at 3,000. S&P at 1676. All these indexes are at basically historic highs at this point. And to me, it's like you said, it's a lot of companies buying back their own stock. It's institutional buying. Should a lot of people benefit 401ks and their retirement plans right now? Sure they are, but what's going to happen when everything decides that it's just going to fall off the cliff and it gets cut in half again? Then people's portfolios will be cut in half, and then the president will say what? Oh, well, hopefully you got into something safe. I mean, what's safe? Most of these 401k plans are buying up government debt, treasuries. You know what I mean? And this is almost the same exact thing that happened the last time. I mean, you can see the bubble forming right now.
That's the problem, Ryan, with the QE-based economy is it supports two areas of the economy. It supports the stock market, as we've discussed, and it supports real estate. The problem becomes that when they pull the QE, the stock markets, per Bernanke's admission, and real estate markets tank, and all that wealth that supposedly was created, which was supposed to boost the economy. People feel wealthier because their homes are now not from underwater and they have home equity that they can extract, or their stock portfolios are higher, so now they can spend money. When those come down, there's nothing left. You spent a couple of trillions of dollars. Temporarily, people felt wealthy, but when that wealth evaporates, there's nothing underlying the economy. So that's the real problem with QE is it is false stimulus that once it's pulled away, you've built nothing underneath. You haven't built a productive economy. You haven't built an economy that can support more jobs. The only thing that keeps the economy going, and this is Bernanke's admission, is the low interest rates, which is sending a false signal to entrepreneurs that the economy is fine and we should spend money and we should buy stuff and we should buy houses and we should buy stocks and bid them higher. But once they stop with that, it all goes down.
Exactly.
And then you have nothing. You've spent the money, and there's nothing to support the economy.
And the irony of their comments about, the low interest rate situation and that they know that that's the only thing that's moving the economy right now is who's really benefiting from the low interest rate. It's not the consumers. It's not. Because they don't have access to that cheap money.
It's not the middle class. It's not the poor. It's basically the largest banks and the richest people who have access to that capital. And now they're seeing if you're going to raise rates on us, these are the investors in real estate like BlackRock and other people who have access to cheap credit. They're like, well, we're not going to buy houses anymore. We're not going to invest in the sector because the return isn't there anymore. Exactly. And I had a conversation with a reporter, and she was saying, well, now that the investors are out of the market, isn't that better for the average mom and pop person who wants to go out and buy a home? I said, no. It's telling mom and pop it's not a good investment anymore. Prices have gone too high. And it's almost like when your dinner companion is finished most of his meal with the part that he doesn't want and says, okay, I'm done. This is gross. Want it? And you're like, sure. Yeah, I'll take the leftovers. So the fact that we're removing these cash buyers from the market doesn't mean, oh, great, now Ryan and Lewis can go buy a house. No, it means they're telling us that that's not a good investment anymore because prices have gone too high.
Right. It's telling you that the numbers no longer work as an investment. And when the minute that you start to see these big hedge funds pulling money out, I mean, that's a big red flag. And I think it was in a majority of 10 different metro areas last month, 40% or more of all the transactions were all cash deals, which is amazing for me. And in the major metro areas, which tells me that in the majority of those deals, it's investors buying that stuff. It was, and I have some numbers here. This is all from Realty Track. 58% of the 58% of the sales in the state were made in all cash, according to the report, in Nevada. But it's not just Nevada. All cash deals in Florida comprised 57% of home sales during the month. In the state of New York, it was 51%. In Vermont, a whopping 80%. This is, and this article is on CNN Money, but those are amazing stats right there, though, Louis. I mean, to think that we have some sort of a normal market, real estate market going on right now, there's absolutely no way with 50% of the sales being cash deals. I mean, and you know what? A lot of these deals are, Louis, are distressed sales, or they're homes
right.
that need to be fixed up and flipped. They're not your, like, you know, move-in ready turnkey homes that people are paying cash for. That's not what they're buying.
Right.
And so I think that's also where these numbers would be skewed, because people think, hey, well, a lot of people that have, you know, homes that are dilapidated or whatever else it may be, and the markets have rose in these metropolitan areas, are saying, oh, now's my time to get out. An investor would swoop in, pay cash for the deal, fix it up, and be able to sell it for market value. That's more of what I'm seeing. And I think that, you know, it's going to be interesting to see how long this plays out. I know many investors, Louis, are actually getting like guidance line of credits for $1 million, $2 million, where, you know, they can actually, if they've got a history of flipping houses, where you can go and get a guidance line of credit, put 20-25% down, and then you do the renovation. So you're not actually having to come up with all the cash. The bank will still finance that stuff. So there are some banks that are actually doing that stuff now, and I don't know how long this can last, because I'm seeing the value shoot through the roof. Take D.C., for instance. I mean, in certain streets, you're seeing like 30% going up in literally a year, because what they're doing is they're going in and renovating these homes, making them basically, instead of a 1920 townhome, now, you know, built with all the modern features and everything, and instead of being $400, it's now worth $700. I mean, it's crazy what's going on out there right now.
I know, Ryan. Let's take these guys out of the market. Let's say it runs its course, and now the cash buying goes down to normal levels. It's, you know, single digits, 10%. It doesn't reflect any type of massive influx of cash buyers. What does your normal market look like at that point?
Your normal market would actually see a large increase of supply of homes, because many of these investors would then be stuck with these houses, having to probably, instead of selling them, renting them out. And what we're going to have is the normalcy is going to be that I would take out, I mean, the metropolitan areas are obviously, they're going to do better than the rest of the country. But it's going to be, you know, very small incremental rate of returns in these areas. Many people are going to continue to rent because they can't get mortgage loans to begin with.
Right.
You know what I mean?
Doesn't the price then, and I guess there's an argument that when the investors leave, there may be an opportunity for the mom and pop, because not initially, but eventually, prices should start to erode. If they're no longer there, in a sense, they are a precursor to pulling QE away. The reason the prices rose was because of all the easy money through QE. Well, if those investors pull their money from the housing market, then prices should drop, and that could provide an opportunity for mom and pop home buyers, provided they can get access to capital. Now, if the investors are pulling because QE is being pulled, well, that means rates are rising, but prices are falling.
Yep.
That might not be a bad dynamic for home buyers. The worst dynamic is home prices are rising and rates are rising.
Yeah, well, you know, I think you bring up a great point, because it leads me into an example that I've been seeing a lot, especially in the Northern Virginia area. But if you take cash out of the system pretty much, and it's just, you know, like that's only 10% of the deals, and 90% of the deals are now finance transactions, the home prices will shoot down immediately, Louis. And the number one reason is because when you do a cash deal, there's not an appraisal required, right? So if you see a deal out there, right?
Other than the cash person's, they don't do an appraisal, but they do evaluation on their own. Yeah.
Correct. But what's happening is right now everybody's missing out on deals because there's financing contingencies in place, and they're getting bid up. So even a lot of these other cash deals, for people that are even buying their primary residence because they're just saying, hey, this is just a great investment right now for us to make, let's pay cash for it and then worry about financing it later, right? So they overpay for the house now. So let's say if instead of paying $600, they say, no, we'll give you $650 cash so that they can close. They can close right then and there. There's no contingencies. The seller's happy. They're going to move forward with that cash contract. Well, what they essentially did was the buyer overpaid because they're just looking long-term. They think that it's going to be a good investment. They'll turn around and refinance it. Well, when that sale gets logged into whatever multiple listing system, it gets logged in at the $650,000, regardless of what the last sale was, which it could have been $600. So it just drove the price of homes up almost $50,000 because of the cash. Cash is king. If you take cash out of the equation, there's nobody in their right mind, a bank, that's going to go from a $600,000 sale to $650,000.
That is the argument against BlackRock, saying they weren't influencing the market because the percentage of housing they were buying was such a small percent. But their impact on the comps of the houses they were buying was driving up the price.
Oh, that is 100% true because, you know, any time that you're buying that house cash and whatever price it may be, I guarantee you a bank probably wouldn't necessarily lend the same amount on a cash deal, especially on, you know, distressed sales or homes that need a little bit of work. The investor might pay a little bit more than that house is actually worth. But the whole time they're just driving up comps and driving up comps. And that's what's going on, especially in D.C. metro area where we're seeing just tons and tons of flips going on where people are buying.
Let me ask you,
Ryan,
the comps that you're looking at, and you do this all the time for our listeners, how many do you pull in a metropolitan area to get a decent sense?
I would say realistically you need 3 to 4, right? You need 3 to 4.
And how many do you think you look at, though?
Like really dive into, like, okay, let's just use an example. Like if I had you know, a 4-bedroom, 2-bath house in DC, and I've got 2 solid comps, maybe like one on the high end and one in the middle range, and I want to shoot for that high end, I'll basically use those 2, right? So if I have 2 solid comps to work off of, I know that I can pretty much get an appraiser to be able to come close to hitting that sales price that I would set for that home. I think 2 is key, 3 is better, but I really would dive into the top 2 and really go deep with those. But you don't need that many, and that's why what I'm saying exactly is if an investor comes in with a cash deal, that one comp gives you almost enough leg to stand on to continue to drive prices up. Because
right. So it has a ripple effect, I guess, is the point I was trying to make, that 1 or 2, and remember, it's concentrated when they're buying in the metro areas. Their purchases and their participation in the market or just being in the market has an impact on the housing prices. And when they pull back, it's going to have the reverse impact.
Yeah, and you know what's interesting too, Louis, is that you know, we always talk about, you know, local real estate markets, right? And everything is like very hyper local. So what's interesting is that, okay, let's say that some investor doesn't necessarily know a specific area within Northern Virginia or D.C., a subdivision that's on the outskirts of a better neighborhood, but they think that because that better neighborhood is only 2 minutes away that they can, you know, compare their house to that one. It doesn't always work that way because, and the interesting part is it depends most of the time what appraiser goes out to appraise that property. Do they have knowledge of that subdivision? Or are they just going to go within a mile to another subdivision and say, hey, this is basically what I'm comping to because this is similar square footage. You're not always supposed to do that. And in a lot of these metro areas, it's a hodgepodge of homes. So it really depends. It's a crapshoot as to what appraiser goes out there to appraise that home. And in the case of the cash circumstance, it doesn't matter because they're doing an independent valuation. I see it all day long, Louis. I mean, like I said, I have firsthand knowledge because I do this myself. I invest in properties and do flip them over. And I can tell you all day long right now, if I'm buying in Maryland, let's just give you a for instance, in Prince George's County right now, I can tell that this is an up-and-coming area because it's on the outskirts. They're building around in the Maryland area. It's called National Harbor. Fort Washington kind of butts up against it, but I can tell that that's where everything is moving because it's a little bit cheaper. You're in the, $140,000 to $50,000 range, but if you buy that house, you can easily resell it at close to $250,000, $260,000. Okay, so a lot of the time, Louis, if I see that a house is at $140,000 and I just do a quick walk through that house and everything looks good structurally from the outside, I don't do anything. I just say we'll close at the end of the week. You know what I mean? There's really not much, and that's exactly what investors are doing right now. A lot of them are just doing it sight unseen, and that's throughout the United States. They're just picking a metro area. They're saying, okay, if I can get it at this price, then I don't care. I'll close within 3 or 4 days, and that's how deals are going down now. And it's very interesting for me because, I thought that with that uptick of interest rates that we had over the last month or so would really pull back investors, but it still hasn't.
Well, they still have cash and they still have money in their portfolio. But Ryan, you made a great point maybe 3 or 4 weeks ago. You predicted that if rates were to rise, the party wouldn't be over right away because the ARM would rear its ugly head. And I saw something yesterday that ARMs are up to their highest level now since 2008. So you nailed that one.
Yeah, and it's going to be really interesting. We definitely want to continue to pay attention to the ARM interest rates and the 30-year fixed rates. And a lot of buyers that I'm seeing right now are actually the buyers that I was talking about, 6 months ago, Louis, when I said, don't wait for interest rates to go to 3% before you make your move. Now they've gone up. Everybody's like, well, I don't want to miss these rates. We've got to move now.
Right. And that'll last for a while until people realize, wait a minute, maybe they did miss the boat and they shouldn't be getting on it right now.
Precisely. So I think that this is probably going to be the trend going through the end of this year, where it's those people that feel like they've missed out on those rates but are saying, hey, we still need to move because we need a bigger house for our family, and we want to go ahead and lock in as a lower interest rate as we possibly can. They're going to do that through the end of this year. And then I think, because like I said, I don't think the Fed's going to do anything with QE. I think they're going to keep it completely the same as it is. If not, I don't think that they're going to be bold enough to stimulate again even more unless we have some really bad economic news come out.
But if they don't, Ryan, isn't it really then everything is the same, meaning this bubble-driven, QE-driven economy with housing and the stock market still has a ways to go, meaning if they're not going to pull the QE, this kind of worry that housing is going to slow down or that the stock market's going to crater goes away, and it becomes classic kicking the can down the road even further because you and I have talked for years now that forget just QE and the amount of money that's being spent there, we still have the underlying structural issues, which just last week we saw with Detroit. I don't know how that gets kind of swept under the carpet, like, oh, it's just Detroit. Everyone knows Detroit's a basket case. No, Detroit is supposed to be the manufacturing capital of the world. It's not supposed to be some no-go zone that you can't go to in the United States that's bankrupt. And the reason they're bankrupt is because they got into the classic situation that the United States is in. They spent too much money. They borrowed too much money. And you don't hear the Keynesians saying this is an aberration. They just ignore it. This is exactly what happens when a government spends too much money and doesn't manage its finances properly. So we still have all these issues, but in the short term, everything is fine because if they can keep putting more money into the system, housing and the stock market could continue for at least another 6 months.
Yeah, I would agree with that. I mean, I think that, we say 6 months, Louis. I mean, the way things have been going, it wouldn't surprise me if they push it out another year or two. You know what I mean?
We were predicting collapse in 2010.
And I think what we really did
by 2012.
I think what we did was we underestimated how much the Fed has control of this thing and able to manipulate things in such a fashion that this can really be, go down the road for who knows how long. I mean, when you see the stock prices where they're at and you see where interest rates are, and we know that all this is artificial. It's not real.
Well, you know what the gifts are, Ryan? Japan and Europe.
Yeah.
what Japan has done is come out and like tripled down whatever Bernanke's doing. So the U.S. looks like a safer place. Europe is a basket case. The BRICS, they're not really powerhouses. So the United States is still viewed as the safe haven. They've managed to distract people from gold and silver. So the dollar is king dollar, and irrespective of whether it gets printed into oblivion. And really the only thing that can stop the United States would be China. But China is we overestimate China. China's a mess because their recent PMI showed a contraction. A lot of their growth is based on just printing up renminbi and building these big cities in the middle of nowhere. So the United States, in a way, as many people have said, is the cleanest shirt in the dirty laundry bin. So that's why we're able to continue to do this. And there really isn't a large market in gold and silver. And if people want security, well, maybe stocks aren't the right way to go, but buy a house. That's not a bad thing to do. And that feeds right into the whole low interest rate environment, is that if we can convince people to borrow money, the economy will be better. Yeah. And short term it is. If people spend money, the economy does a little better.
And the interesting thing is, Lewis, to be honest with you, I still think that as an investment, real estate is a very sound investment if you're able to take advantage of the low fixed rates, right?
Or get a good price at a higher rate.
Exactly, or get a good price at a higher rate. I think that if I'm using it I look at that investment and I'm looking at what rate of return I can make. If I use a real estate property as just a rental property and I just rent it out year round, what my returns are in different metropolitan areas that I know the rents are going to be stable, if not increasing, I could buy as much as possible right now if I had access to as much capital as I want.
Right, and that's what BlackRock did.
And that's what BlackRock did. They're basically, as a hedge fund, they take people's money, they pay them a rate of return, and they got to buy up enough real estate that produces enough return so they can pay their investors back. And I think that it's going to be really interesting to see what transpires. We're living in a fantasy world right now, but you bring up a great point. And when in the world is Europe going to get their crap together? I don't see it anytime soon, right? So as long as they're struggling, as long as Japan, China, as long as they've got issues, I think that we're going to continue this. This isn't going to change. And I think that the telltale sign will be is when we start to see those gold prices rising back up again, Lewis. I don't think until we start to see those things moving again is when people will actually start to panic, when people will actually start to say that, hey, this isn't going in the direction we want, even though we know the Fed's manipulating everything and that, employment's terrible, money's cheap, but the middle class and everybody else doesn't have access to, just the big banksters and the rich have access to that capital. I don't think that the rest of the country and investors are going to wake up to what's actually going on.
But you know what? The reason they didn't, and you point out that the Fed has control, and they really do. The reason gold ratcheted up 2009, 2010, and silver as well, 2011, to record highs was people were waking up to the fact that the economy was being boosted or attempted to be stimulated by TARP, by the Recovery Act, and by QE, and nothing was happening. In other words, money was being poured at the problem, and all that we were doing was increasing our deficit and increasing the amount of money that we were throwing at it, and the economy wasn't improving. But what happened to gold and silver was the ultimate crisis never happened, and it took another couple of years, and people said, wait a minute, where is this massive collapse? Where is this massive inflation? Now, there are sides of inflation in gas and food and, of course, housing prices. But overall, it looks like the economy kind of rode it out, and that's what kind of made a lot of people who jumped onto the gold bandwagon, not by buying physical gold or silver, but buying the ETFs. They traded out of those things quick, fast, and in a hurry once they realized there was a ton of money to be made bidding up stocks while gold was going down. And there was a ton of money to be made in investing in housing. So what the Fed did was they stuck at the QE game long enough to show results. Because if you remember, when you and I were doing the CBS radio talk show, they were pouring money out in QE1, QE2, Employment wasn't getting better. The stock market didn't go anywhere. Housing was still in the doldrums. But because they continued to pour money at it, they did 1, 2, QE3, QE plus, it finally took hold in the last 7 to 8 months. And that coincides with, the rise in the stock market and the rise in the real estate market, the real declines in gold and silver.
Yeah.
Is people said, wait a minute, I don't need a safe haven. Everything is fine, at least from an investor standpoint. Now, if you're unemployed and you realize things are no good, you don't have money to buy anything anyway. If you're doing well, it doesn't make sense to buy gold and silver. It makes sense to buy real estate where the returns are. And it makes sense to be in a stock market that's hitting record highs every day for the last 9 months.
Yeah, and my theory is at this point, Louis, is that it's kind of like you said. The Fed at this point, they're backed into a corner. They can keep things the same as they are right now. They're not going to taper. It's not going to happen. I don't care what the media says. They're not going to reduce their purchase from 85 to 65 because even that would be tipping their hat that things are getting better and the markets would run with it. And then the next month they'd have to backtrack again. I think they realized they made a big mistake when they opened their mouth just hinting that there was a possibility of that. And I don't see them making that mistake again.
You think they don't want to damage what I just outlined as the good work they've done by creating stock market bubble and real estate bubble?
Yeah, they almost crushed all of their credibility this last time. Not that they really had any to begin with, but as far as the markets are concerned. Once
those go away, there's nothing left. I mean, if you don't have if the stock market collapses 40% and housing prices come down, you are back not just in a recession. You have nothing to build from.
Yeah, it's pretty much game over.
They can't allow that.
Yeah, and they won't allow it, and that's why I'm almost where we are now. I mean, we look at the next election's not until 2016 at this point. I don't see anything changing between now and then, Louis. And I honestly don't think that Obama nor the Fed is going to allow for anything to happen during this presidency. I just don't see it happening. I think that they can actually probably ride this out for 3 years. Now, as to what the Fed does in between then is the big question. Do they continue, like you said, to continue easing, to continue to buy more mortgage-backed securities? Because that's the only leg that they have to stand on, like you said. I mean, it's just like this endless bucket of money that keeps falling out, but the only people that it's reaching is the people at the top.
But isn't it astonishing how long they can do that? That really shows that if the Fed was not doing this, we would have gone into one of the greatest deflationary spirals in history.
Yeah.
Because without the Fed spending, they're producing, with this massive amount of spending, anemic growth, if you can even believe that there's any growth. And the growth is very uneven. But as you and I have discussed, had they done nothing, and we saw evidence of this in 1920, I think it is, economies on their own will restructure much quicker than when you artificially try to manipulate where money should go and how much money should be in the system and what interest rates there should be. It's the same thing what's happening with young people today. I did a blog post showing maybe 50 or 60 or 70 companies that were started, iconic names, by people who either never went to college or were college dropouts. Now, when people today think that the only option culturally, and because they're kind of forced into college because there's a free loan there for them, when you have that type of situation, they use no creativity. They don't even think what to do. They're not forced to do anything because they can either go to college on the loan, spend 4 years, not really thinking about what they're going to do other than relying on the fact that they're in college and somehow that's going to get them a job. They come out of college, okay, they live with their parents. They don't do anything then either. So there's not this incentive. There's nothing in the economy that says go out and make your own way. It's almost wait until the economy improves and then you'll get a job. Well, that takes away the dynamic aspect of the economy. Here's some of the companies, just for our listeners, who were started by people who didn't go to college. Apple, Oracle, Microsoft, Facebook, Twitter, Dell, Gateway, McDonald's, Wendy's, In-N-Out Burger, Subway, Napster, BlackBerry, Ford, DreamWorks, Mrs. Fields Cookies, Famous Amos Cookies, Kroger Supermarkets, Tumblr, Whole Foods, Disney, Virgin, Chiquita, Lowe's Movie Theaters, MGM Movie Studios, Boston Chicken, Hearst, Getty, Pixar, JetBlue, Ogilvy and Mather, IKEA, Omniture, United Artists, Best Buy, and the list goes on and on and on. Rockefeller, these people didn't go to college. They decided that what they were going to do was make their own way because there was nothing there for them in college. But when you create an environment that somehow says college is your answer and we're going to make sure that you get to go, well, now you're kind of pre-programmed as to what your destiny is, and you don't create Best Buy, you don't create Apple, you don't create these companies. And then people say, oh, those are just, rock star examples. Sure, but there's millions of other examples of entrepreneurs and people who made it without just taking the traditional path and without incurring enormous amounts of debt. And I think that's one reason the economy is stagnated. People are thinking, oh, we'll go to college, we'll get more education, and then somehow because I've been to college, a job's going to appear.
I agree with you. The government has actually instilled this belief in people that you are productive when you go to school, right? You are actually productive when you go to school and you learn because it's going, by the time the economy finally turns back around, you're going to be able to get a job. And unfortunately, there's really nothing productive that comes from going to school because when you get out, like I said, the reality is you're going, unless you're starting a business on your own where you have to think for yourself and really run things, and you're going to work for somebody else. And they're going to train you the way they're
going to teach you, right?
They're going to teach you how to do that. You could do the absolute same thing with the age of the Internet and the amount of information that's out there for you to take in. You don't have to go to school for one day. You can open up your computer, pretty much learn to do anything you want, whether it's learn to speak a different language, learn to play golf, whatever it is. You can learn it on your own.
You can learn history. You're right. You can learn just about anything. You can buy DVDs. You can download lectures.
And how cheap is it, Louis? How cheap is it to do that?
Oh, it can be anywhere from free towards something a little more formal. You can buy courses. I mean, it's the amount access to information and access to skill acquisition is very low. When I ran a fairly large company, I realized that just about every employee that I had did not need to have gone to college to do their job. One of the most important skills that I required was good people skills, customer service skills, good phone skills, and the main one that you never learn in college, and they really should at least teach this, is Excel skills. You ask somebody to tell you, how did the traffic do? How did these customers work on a if you take them as a group versus another group? You have to know how to be able to put the data into a spreadsheet, into Excel, and then be able to analyze the data. You don't learn that in college. So basically every job of the 120 employees that we had, most of them had nothing to do with having gone to college, and it really didn't matter to me if you went to college or not.
Yeah, and I agree with you. You know what the thing is in a lot of those, people, it's not, and see, if they don't own their own company, it's hard to actually pay attention to what the results are, right? Like when they're working for somebody else, they could probably care less about it. And somebody doesn't teach them how to do an Excel spreadsheet, they don't want to do it.
Well, they just want to know what their benefits are.
And when they get their paycheck.
They're almost told that you're entitled to have this job and you're entitled to keep it. And once you have that mentality, your productivity goes down. There's no two ways about it. And you're kind of conditioned to think that somehow the business owner or the company itself is evil and is somehow out to screw you in some way, shape, or form. They're not there to produce computers cheaply for you to use. They're not there. They're there to make sure that you don't get paid a living wage. Or they're there to make sure that they don't hire you or they don't pay you enough money. And companies are really, if you think about it, companies are the only productive entities in a society. They're the ones who produce the goods and services. Without them, the government can't give you anything other than that which it takes from a company.
Yeah.
So if you weaken a company and you strengthen the government, eventually the government has nowhere to take the money from.
Yeah, it's interesting, Louis. I often get asked by people, they're like, well, you had to have, what you learned in college, what courses did you take? It had to help you in growing your real estate business and doing the things that you've done and opening the companies that you've opened. I said, absolutely not. It hasn't.
Well,
really
you learned to play basketball. You had some good friends. You learned maybe how to drink too much.
Yeah,
and you might have learned some good English literature or some philosophy that you could have learned otherwise.
Absolutely. And the skills that I learned were more from the sports. And see, I started to look back, and if I were to do things all over again, and I can actually tell you this because I'm confident in saying it, that if I didn't go and play basketball at college, that I wouldn't have physically probably gone to college if I know what I know today. Because I would realize that I could have started my business 4 years earlier than what I did, right? I could have really thrived earlier at an earlier age than what I did after burning those 4 years up. Because
that's because you knew you wanted to start a business. Now, for someone who doesn't want to start a business, they still want to get a job, and they figure they need to have skills. Well, unfortunately, that person is correct in the assumption that not that college gives you the skills that the employer wants, but for some odd reason, the employer requires college before they hire you.
Yeah, but and still today, I tell people all the time that even though companies say that it's a requirement that you must have an MBA, or that's not always true. I've got plenty of friends that have jobs that they have no business having, either A, because they knew somebody, or B, just because they showed up like nobody else would. You know what I mean? And that's still out there. Like, I don't care what they're pushing. As far as the government's concerned about, you need this degree to have this job, it's not true. And the people that work the hardest and are willing to advance themselves are going to get what they want in the end. But it's just a mentality, like you said, Lewis. But I think it starts from what you're trained in high school. I mean,
even before then.
Well, even before then. But imagine if, like you said, in high school they're teaching you how to run Excel spreadsheets. They're teaching you about credit cards and personal finance. And
they're not though.
That's my point. Imagine if the system was set up that way, we would no longer have the need to be dependent upon student loans and going to school, and the price of college would actually come way down. Right?
You think of how much money we already spend in property taxes for the local schools across the country, and you find that people go through 12 years of school, and they don't have basic skills so that when they get to college, they have to have remedial math and remedial reading and writing courses.
Yeah,
we've already wasted all that. I mean, by the time if you've been learning something for 12 years, especially in your prime learning years in terms of your ability to absorb information, if you haven't learned it in the first 12 years, you're not really going to do that much better by the time you go to college. So we've already failed at that point.
Right.
The fact that you have to go to college to get yourself ready for a job, by the time you're in sixth grade, you should have all the mental skills. You may not have the maturity or the judgment, but you should know how to add, subtract, multiply, divide, speak English, write a business email. There's really not much more you learn after that other than some facts and about history or some, and that's where you round out your education. But we're finding people graduate high school and don't have the basic competencies. So making more people go to college, you're just papering over the issue. That's not going to make the workforce more productive or more educated. You're just sending more unqualified people into the educational system, and you're putting them into debt in order to do it. Then they come out, and they still can't get a job.
Well, during the election and the campaigning, I mean, Obama was pushing the whole time that it's, having access to schooling. And that's the dream for everybody. That shouldn't be the dream that's getting pushed out there, is living a debt-driven life, right? I mean, that's not the dream.
It's an educated life, and you're actually saying that education only comes from one place, a school that you pay a lot of money to go to and borrow money to go to.
Yeah, absolutely. And I mean,
Thomas Edison's another one. We wouldn't have the light bulb. We wouldn't have motion pictures. We wouldn't have recorded music. He didn't go to college. He was homeschooled by his mom. I mean, there's a myth that somehow all of the legendary learning and accomplishments come from sitting through 4 years of college and then going 2 years after to get a master's degree. All you get from that is you get economists who don't know what they're talking about.
Yeah, well, and we have the economists now that are trying to rationalize everything that the Fed's doing as if that it's going to be okay from here. They know.
Right, not challenging the underlying assumption.
Exactly.
Is it really a normal economy? Is it really economics to throw a third party, basically officious intermeddler, to say, well, if the economy doesn't work because we're not studying economics, we're studying how we can interfere with the economy and try to fix it.
Yeah, and
that's the basis of that type of economics is how can we throw a third party, i.e. the government or a central bank, and manipulate the economy. That's the basis of that style of Keynesian economics. It's not a study of how markets work. It's a study of how they think markets don't work and how they can fix them by using public money or money they print out of thin air.
Wouldn't you agree that it's going to be interesting to see how the history books are going to rewrite this period of time and actually see how economists explain what took place during these years? I mean, because you can't really explain it other than it's an artificially manipulated market. They will say that, you know, the Fed's job was to keep inflation in check and all this stuff, but in reality, you know, the Fed is the wizard here, and everybody else is just following suit. I mean, that's what's happening here. I mean, the Wall Street is looking to the Fed for all the answers because they're hoping they have the answers because
and college too. They are sending people down paths that they otherwise might not go, and thereby you're shutting off alleys. You're creating blind alleys where people otherwise might go, because right now you have to be in the stock market. Right now you have to go to college.
Right.
Other great things might happen if they didn't artificially manipulate you into this one particular, you know, where they're trying to drive you because they think it's going to fix everything. As if everyone can have a house, the underlying economy is better. If we just get enough people moving in and out of houses, everything's going to work out.
Yeah, I mean, it is kind of, you know, one of those things that's, you know, it builds momentum, right? When somebody sees their friend buy a house and they want to buy a house, I mean, you build up that positive momentum. But at the end of the day, I mean, I guess we'll continue to say this time after time, how, you know, this isn't sustainable. Obviously, the Fed can manipulate this for an extended period of time. I just don't know how long. Obviously, you want to take the steps to protect you and your family now, and protecting yourself from the future inflation that we always say is eventually going to kick in when we don't know when. But when it does, it's going to be brutal. And if you're able to lock in an interest rate sub 4.5%, I think right now the overnight average rate on a 30-year fix is 4.39%. Last week it was 4.35. The 15-year is 3.45. And the 5-1 ARM is 3.44, which is almost the same as a 15-year fix and about a point difference between the 30-year fix. Then you should probably look into doing so, or try to position yourself. If this train and this party is going to continue for the next couple of years, if the Fed can continue to manipulate and keep interest rates low, put yourself in a position to take advantage of this stuff.
It's the game we're in.
Exactly. Protect yourself and your family long term.
And we will have inflation on. You know why? Because the Bank of Japan and the Fed have said they have inflation targets that they are woefully missing. They are trying their hardest to create inflation as defined. They've already created inflation through the increase of the money supply. But
yep.
they are trying to create inflation as measured by the CPI, and they are missing. And they don't like to fail, so they will print more. You saw what Japan did. They just tripled down. They said, you know, we're going to do stimulus like you've never seen before. Eventually, They'll get what they're looking for.
Yeah, they will. It'll rear its ugly
They're not
head.
going to stop just before it gets. They'll create that Frankenstein, and they won't know what to do with it.
Yeah, I agree. It's going to be interesting to see how it all unfolds. Louis, we're coming up on the end of the show, and I wanted to give our listeners. Obviously, you do some consulting for companies and marketing and media strategies. Where can they go? Give them your blog. Tell them how they can reach out to you and get in touch with you.
Thanks, Ryan, for the opportunity. Go to smaugld.com, SMAULGLD. We have a blog there that discusses real estate and economics almost on a daily basis. And then also there's the Small Gold YouTube channel, which is new, which has the first 4 podcasts for Real Estate 360 of Ryan and myself. And you go there and you basically get a good dose of economics and real estate. And if you want to contact me, my contact information is at the About section.
Perfect, Louis. I appreciate it. And you have a great week. We'll talk to you next week, okay?
Thanks, Ryan. Thanks, everyone.
Thanks, guys. I appreciate you tuning in. You can always reach out to me at 877-245-2030 for any questions. or at realestate360live.com. The website is under construction. Will be done by the end of the weekend. For any questions, concerns, you can also go there. There's a contact us spot. It is still live, but it is under construction. So there'll be some changes that we'll be making for the better. Have a great week, guys. We'll be talking to you next week.